Anton.
Whitten.
How are you, mate? You've been relegated to less technologically advanced stuff today, I hear.
Mate, I prefer to think of it as because of the mass power out down here in Victoria, because of the clubbing storm caused by Dan Andrews releasing us back out into population, which has caused I think probably they'll announce on the wind tonight. They'll announce on the news tonight that this will be the worst winds that we've had probably in 50 years.
Wow.
Down here, certainly on the peninsula, 155,000 customers out of service and that's just in the lower peninsula sort of area. So that'd be close to 1 million people without power. We've been out since 7 o'clock this morning. And but I prefer to think of it that we've gone natural. So I've found the only room in the house that has some natural ambient lights coming in, and
sunlight. Yeah.
Ladies and gentlemen, this is what I really look like without the technology.
Well, to fill in the gaps, folks, Andy has been without power for over 24 hours, I think, he's saying. And where he lives, you need power for the water.
Yep.
You need power for everything. So he's unshowered. So thankfully it's not a live show. Mate, so good to see you, mate. Folks, we might not, we may or may not do a full-length show today, just depending on the natural light down at Andy's place, and maybe see if his phone can actually last, because we're on battery.
It's on its last legs, mate. I was running my appointments today, driving around in the car just so I could charge my phone.
Well, mate, good we could at least do something. And a big shout out, say hello, Margaret, James, Sean, and I see a few of you guys on there right now. Got some good numbers, some great numbers. Give us a shout out, who's online and where you're dialing in from. Great to see everyone here today. Andy and I want to talk about a couple of things that we chatted about a little while ago, and they're on the lips of most commentators at the moment. But as you guys know, we've got a little bit of a show here, Wealth, Wine and Wisdom. Andy and I have been doing this for 18 months, almost heading on towards 2 years now, since the world of COVID kicked in, and we decided we'd do a little bit of a weekly debrief for everyone in our networks, our communities, the property investing community over my side, the business and financial planning community over on Andy's side. And we thought we'd try and make sense of it all, and we just kept on going. We've enjoyed a Friday wine and having a little look at what's been happening this week, and we try and debrief the week and try and offer some wisdom. As the wine increases, the wisdom decreases. I think there's an inverse correlation. More wine, less wisdom, but maybe there's a bit more fun in it, folks. So welcome along. Great to have all of you guys here. We've got someone dialing in from the sunny coast. Christy Lee, good to see you. Someone in there from the Yarra Valley.
Yep.
Facebook user. Yeah. Andy's wearing a hoodie. Is it a hot day? Well, no. And if you missed the beginning, Andy's been without power for 24 hours down in Victoria, where he lives on the peninsula, and no showering, no, and it's a bit cold. Anyway, I think hopefully, Andy, you get the power back sometime soon. Now, fingers crossed, mate.
There we go. It just said 20% battery power.
Oh, well, why don't we dive into it, folks, before Andy's battery runs out. He can't charge it. So we've got 20%. So that's probably 15 to 20 minutes, maybe. So I reckon, Andy, we dive into what's in the news.
Let's jump in.
Yeah, for everyone listening in, what we'll do if we don't get a chance this week, if Andy drops out because of power outage, we'll circle around on this one, because I think, folks, what's in the news? Yeah, Tesla batteries for sure. Tash, Andy needs to put that Tesla battery. We were just talking about that off air, actually.
Yeah, we wasted about 20% of my battery power talking about whether I should have got a Tesla battery by now. And,
yes,
it was unanimous. I should have.
It should have. Well, folks, let's have a look at what's in the news, because Andy, there's some interesting things out there going on right now, which both you and I were talking about. Well, you mainly in the world of inflation and, kicking on potentially into something that's at the heart of every property investor, probably every Australian, interest rates. But, mate, talk us through. We saw this thing, it says here that the headline, sudden dramatic surge in 3-year bond rate. Okay. What does that mean to us? And which means that the banks are sort of jacking up, fixed home loan rates. What, WTF, what's going on here? Talk us all through that for us, because it's certainly not my wheelhouse. It's yours. Tell us what's going on here. And obviously inflation is going to be a chat if we can sneak it in as well.
Well, look, inflation's at the core of some of this. And, we've spoken about this ad nauseum, and this is exactly what we said was going to happen. And we thought that it was probably going to be a little bit further down the track, but it's probably brought forward. But we do need to be careful about the headlines. And as you and I always articulate, there's a lot of sensationalism. And let's face it, Jace, when the rates are at 0.1, well, if they just go up by 0.1%, then they've doubled. So they have soared, right?
Yeah.
So, but there is a reality to that. But anyway, so there was a chart in the Fin Review today. It was actually quite a balanced article.
This one here.
That's the one, Jay. So this is the forward-looking 3-year bond yield, if you will. So what the expectations of bonds will look like in 3 years' time, and so it's basically saying now that they believe that the rates are going to be up, well, from 0.1% to 0.6. That's a 600% increase, isn't it? So that's astronomical in anybody's world. When you put it in percentage terms, when you put it into where we've come from, realistically, it's not even 12, or it's a little bit over 12 months ago. It's 24 months ago since rates were at that kind of level. Now, that doesn't necessarily mean that that's where rates are going to be. That's expectation of where rates are going to be. And expectations are driven a lot by emotion. And I believe right now they're being manipulated. Those emotions are being manipulated by the fact that for many, many years, and we talked about this probably 10 wine and wisdoms ago, and the headline rate of inflation is one of the key metrics that the Reserve Bank of Australia have used for many years to judge whether they should increase interest rates, or the cash rate rather, or decrease the cash rate, which is the RBA cash rate, right? 0.1%. And they want it to be on that target rate down there at the bottom.
So that's their target right there, right? So, that's where they want to. If we keep it at 0.1, then, we can kind of manage what's going to happen in the future.
And if it blows up to 0.6 and things like that, well, they're going to have to raise that target rate, right? Because they'll need to keep into. So there's a couple of things at play here that a lot of people don't know about. So, and we talked about it ad nauseum, and it talks about it in this article in the Fin Review. I actually like the title. Bond markets push the RBA to close to capitulation. Bullshit is effectively the term. It's a great headline though. But we need to look at what the fundamentals of inflation are, right? And so globally, the Central Bank of Europe, the Fed Reserve in the US, and also the Australian Reserve Bank have come out in the media 6 months ago and said, I'm not sure about the Reserve Bank. I might be paraphrasing a bit much on them, but certainly the Fed and certainly the Central Bank of Europe came out and said, we will let inflation spike above and below ranges for a while because of the anomalous stuff that's causing inflation, which I'll go into in a tick. But we're going to focus on job rates. And job and wage inflation. So wage growth and the unemployment rate.
So, and that's pretty well worldwide, right? Like that's kind of the thing. So let me try and just draw this quickly here, Andy, because I want to make some sense of a few of these boxes, right?
Mm-hmm.
So if we say, all right, well, the bond rate, okay, what does that mean to us? Inflation, right? And then interest rates, because ultimately right now for the end user, right? The end user, most Aussies, most people in America, if we've got a mortgage or we've got some sort of loan, this is the one where kind of like, hang on, what's going on? What's happening here? I want my interest rate. I want a 3% interest rate, okay, right now. And so if this bond rate or cash rate is at 0.1 and it goes to 0.6, right? What does it mean in there and what does it mean in here? Like, is this a good representation of how to connect it, or am I simplifying it too much?
No. If I'd maybe scroll up a little bit and put another box underneath inflation and call it cash rate, and then we can go from there. So inflation, the center box there, was the target that the Reserve Bank sort of had as to whether they should increase or decrease the cash rate. So between 2 and 4% in inflation, if we put 2 and 4% in inflation, 2 and 4% was sort of their target rate. If it was in between 2 and 4%, we're good. If it's over 4%, we need to raise the cash rate. If it's below 2%, then we need to potentially lower it.
So the cash rate as of today, do you know the cash rate?
0.1. Yeah.
0.1.
All right. So
are these directly correlated, or is that just like the bond rate and the cash rate kind of the same?
Well, so the bond rate is actually a speculation on where the cash rate will be in 3 years' time, 10 years' time.
Got you. Okay. Yep. So bond is the speculated future value of the cash rate.
That's effectively how, because when people go, big countries, when they go to borrow money, they're looking at what is a good rate that they should be getting on their investment if they're going to lend money into the economy, or if the Reserve Bank's issuing paper into so they want to figure out what's the appropriate rate, and they're not looking at now because they're going to hold that bond for 3 years, or 10 years. So they're going to go, well, what do we believe the bond rate is going to be in 3 years or 10 years? And the interest rate is going to be somewhere in between. Right. So when there's fears of inflation, because inflation is now, I think, 3% for the quarter. I don't know exactly because I wanted to research it more today.
I think it was up here. Where was it? CPI risen 3% during the quarter, compared with economists expecting to 3.1, the 3.8, quarter 2, etc. So over 3. Yeah.
Right. So then everyone's going, oh my God, inflation is now back up to the higher of the target rate. So in normal Keynesian economics is one of the terms that we use in the scholars circle. But effectively that means it's up at the higher range. And if it's up at the higher range, usually the Reserve Bank would have pressure to increase the cash rate.
Which in turn makes it more expensive for the banks to buy money, which in turn they have to increase the interest rate. Is that kind of the knock-on effect?
Effectively, because the cash rate then is how much the banks borrow money at.
Yep.
And they also borrow money at the bond rates.
Yep.
And then they lend that on as interest rates.
So these guys want to make a margin, like anyone in business, folks. They have to make a margin. They can't buy it at 3% and then lend it at 3%. So they have to have some sort of target margin there. So technically, if they want to, buy it at 1.5 and then lend it at 3, Andy, that's kind of what we're talking about, right? Okay, that's what happens. The banks have got this is wholesale and, technically, and this is retail, what you get sort of at the front end of the shop, So,
Yep. Bang on. But this is what we call standard sort of economics. This is the theory behind it.
Yeah.
But inflation isn't just out of control because of normal times. Inflation is out of control because you can't get wood into the country. You can't get metal. You can't get cars into the country because of the breakdown in supply chain. And so we have got this mass, and in petrol gone through the roof. Yeah. But that's a spike. Right. Well, the petrol is a different thing because there was a bit of a war between the Saudis and the APAC and the US, which has exacerbated the challenge. Filled up the car today, bloody $1.54 for diesel. And that was the truck. That was a truck. The don't have the Tesla yet.
Mate, you need to get the Tesla as well, mate. I just bought a new car, folks, as well. It's 9 months until I get the bloody thing.
Yeah. Right. And by then it will be too old. You'll have to sell
I'll be riding my pushy.
So I guess the point that I want to make here is that inflation is not going to be the core measure that all of the central banks are looking at. They're looking at other areas, but the press are going to bombard.
The press like it because it's historically what used to trigger things,
bang on, right?
Yeah.
And it's going to create great headlines because
sell a few newspapers.
Well, mate, it'll be record increases, won't it? Because when rates are going from 5% to 6%, then down to 4%, and then up to 5%, they're not that bigger percentage adjustments, right? Comparatively to each other. But when rates go up from 0.1%, and if they hit 1%, well, you've got 1,000% increase headlines, biggest increase we've ever seen in the cash rate ever on history, and so that's going to sell papers, or it's clickbait. But it will also impact on markets, right? So less so the property market because you can't sell it quickly, but it's going to, I believe it'll make for greater volatility in equity markets. Because those longer term bond rates are going to be more volatile based off this sort of stuff. But the reserve banks around the world have made it known that one of their core focuses are going to be not so much inflation, because they understand that inflation is spiking because of unnatural economies where supply chains are broken. And those supply chains, as they normalize, will aggressively swing in both directions. So they'll get too high, they'll get too low. They're gonna swing aggressively, right? That's what's just going to happen. Now the Fed Reserve and the Reserve Bank and the central banks, they need to be able to hold their nerve through this swinging and go, well, what's the sign of a real healthy economy? Because if they raise interest rates or they raise the cash rate because they're scared of inflation, then that cash rate jump will go straight into the bottom line on interest rates, and it'll push it north. So that's going to be a bit of scaremongering around. But there is another thing that's actually happening that has got nothing to do with this. And it's the cost of funding is actually increasing.
So the cost of capital from different markets. Folks, while you're sitting there, absolutely. If you have some questions, somebody sort of said, "Hey, listen, I've got a question." Chuck them in the chat. Type out your questions in the chat. I've got a question thinking longer term share market equities. So put them in there. So shares have been a wealth builder of baby boomers. Like, put your question in the chat, folks, and Andy and I'll have a crack at answering them or giving our version of what we think an answer might be. So have a crack at that while we're doing that. This could be one of these little segments that we do, which is things you should know. So Andy, tell me a little bit more about that. So what are you talking about here? You're talking about.
Well, so the cost of funding relates to multiple different things when it comes to banks. So you will see that the banks have already started to raise their
fixed
rates.
Yep.
Now that's similar to the previous illustration that you put up. That's an expectation.
So we've always, well, not always, but there's been an understanding that if fixed rates go down, that the banks are saying, "Hey, listen, we're good with our funding costs. We're locking it in. It's actually cheap. We could probably actually even buy it cheaper, et cetera, whatever it might be." Or if fixed rates go up, they're expecting the price of them purchasing money to be a little bit more expensive, right? And as you sort of say this, correct me if I'm wrong in this sort of section, Andy, because this could be part of what we're talking about. Folks, if you get a 30-year loan, so you might have a contract for 30 years with the lender, with a bank, but the bank might have lent you that money, and the money that they lent you, because they bought it from, let's say, someone, might actually only be 5-year terms, Andy, or whatever it is. This is not exactly exact, but folks, they buy it for 5 years, but they lend it to you for 30. So each time they change over these little sections here, they've got to hedge their bets, because they don't want to pay too much for the whole time, or they don't want to buy it too cheap or too expensive. So they kind of take a little risk in how much they buy the money for and how long they have that money, and they pay it back and they buy it back again, Andy. And this is kind of like probably, hopefully, working towards what you're trying to say here, which is the cost of funding, potentially might be increasing because of, these things, in the background.
Well, the overnight cash rate, or which is effectively the cash rate, that if that increases, then that's one thing that factors into the increased of cost of funding. But that's not the only source, right? Or that's not the only cost related to lending out money. Yep. So the banks have literally, for the last 2 years now, have had almost an unlimited supply of money at basically nothing.
Yeah. Yep. Zero money here. Have this, get it out into the economy.
100%. Now that is now fixed, and the economy will normalize. So the amount of money that's going to get pushed into the economy has slowed. So it's slowing down. So that liquidity that's there is going to be less. And so what happens as a result is that banks have larger amounts of loans on their balance sheet and have less availability for new loans and less, asset base to back it. So there's a net tangible asset ratio that starts to get out of whack.
Yes.
There's also the transactional costs on the banks at the moment, and they didn't repeal a lot of the what do they call it? It's that long ago now. Irresponsible lending. Criteria. So they didn't actually repeal any of that. So the banks still have to abide by that. But it's not just the cash rate; it's also that forward cash rate again. Right. So if that 3-year bond yield rises, even just based on emotion, and it can do that, then that means that you're talking about 5-year funding here. So let's just say it's $1 million loan, Jace, and the bank is going to offer a rate to me and fix it for 5 years. I'm going to go to the market and I'm going to borrow money for as close to that 5 years as possible to hedge my bet.
Yeah.
Right? Now, if that's gone up from 0.1 to 0.6, well, that's a 600% increase in the cost of funding.
Yes.
For me in the future, regardless of where the cash rate is today. Because the cash rate today is just for money today. It's not for money in the future.
Yeah.
So as we see greater volatility in that bond market, it's going to impact on the cost of funding for banks in order to be able to deploy money into the market. Banks are, of course, going to take a far more conservative view on this, and they'll raise their fixed rates over periods of time. Variable's fine. It's just a markup on whatever the rate is today, and it'll go up and down based on whatever happens. But when you start locking it in, that's when you've got to start to look at what's happening.
Yeah.
And now to a degree, people are starting to ask themselves the question, do I start to lock in things now? What's the future going to look like now? And as more people lock in, that sort of solidifies that emotion of the 3 and the 5 and the 10-year bond yields.
Yeah.
And it starts to create more stable trends over time, or at least typically that's what tends to happen.
That's what it does. Well, I mean, for property investors, somebody who wants, and this is an interesting one, Andy, where so if you're an owner occupier and you want certainty for your future expenses yourself, all right, well, I want to lock in my home loan, for 3 years, and I know what I'm going to pay, which is a sensible question. Or, if you are an investor, like you and I talk about, when you actually lock loans in, fixed interest rates and fixed, terms and stuff like this, then you don't get access. You don't get any liquidity in your asset either, or if you do, then you have to, break one loan to get a new loan, and then you have some expenses. So, for example, folks, if you want to buy another investment property, but you've locked your loan in, you've got to break that loan, pay some sort of cost to breaking that loan to get access to the $100,000. So, it's not just, should I lock or should I not? There is always that question, Andy, Do I need access to that asset or some of that liquidity, some of that equity for something else as well? So, one layer of question, then obviously folks listening in, another layer of question. So we do have a couple of questions in here. Speaking of questions,
before we go to them, Jace, the one thing that I'll kind of add into the mix just to make it more complicated, and personally, I reckon we should, and if everyone wants to, I think we should do another session on this next week when I can actually bring up some slides and be a bit more detailed. So because I had a bit prepared, but because it's going to be a hot topic, and this is going to be in the news, and we were saying that this was going to be in the news for a long time, and it's going to scare the shit out of people. Especially what's coming, and we need to be able to read in between the lines, because my belief is that there's going to be a lot of volatility in the bond pricing over the short to medium term. 2, 3, 4 years down the track. And we kind of need to be able to see through that in order to make sure that we don't make silly decisions, and make sure that we take advantage of opportunities when they arise. And what I can guarantee you get, I can't guarantee it. If I didn't have a license behind me, I'd guarantee it, but I do have a license behind me, so I can't guarantee it. But what I believe will come true is that the big banks, right, are going to use this to profit. They're going to use this volatility, and they're going to use it to back up.
No.
I know. I know.
I thought they were looking after me, Andy.
I hate to break it to you. It's like telling the kids about
heartbroken.
I know. And the funny thing is, Jason, there's people out there who are going, "I'll never leave my bank," and gee, it's like your bank will leave you every single day, like dry up the creek, no paddle,
without even a second thought. What do they say, Andy? Like a banker's a fair weather friend. They lend you an umbrella when it's a sunny day, and they want it back when it's raining. Right?
100%. But what I think will be really interesting is Athena, second tier lenders, a new marketplace for loans, which is sort of coming online. I reckon there's going to be some really hot competition in there, and I think that, and you'll probably know more about this on the pavement, because you deal with this every day. But from a theoretical and a funding perspective, what I'm already seeing is I'm seeing that the big banks moving faster and more aggressively, because that means that there's greater margin potentially.
Yeah.
But I'm seeing some of the second tiers being quite conservative in their raises, and potentially even holding, and some have even lowered. And so I think
it's interesting, Andy. The world of non-bank lending. So they are not approved deposit institutions, ADIs. So they have less restrictions and less, challenges in what they do. Less need for less money on hand, less liquidity, less whatever it is. And also just recently, Andy, you probably would have noticed, and folks, we did something at mentoring the other night on finance, where there was a talk about the servicing rate, the buffer rate that the lenders put on top of their qualification for you to get a loan needed to increase by 0.05, like 50 basis points or whatever it was. Now that was only enforced in the approved deposit institutions. So only the banks had to do that. It was outside of the scope of the non-bank lenders, Andy. So they're actually able to provide when the margins, when the prices come back up, right? So the non-bank lenders didn't get the free fucking money from the government, right? Okay, they still had to work their asses off and run a proper business model, which was kind of real. Now, when the banks have to come back to the real business model, the non-bank lenders actually become as competitive, if not better, because they're already in place without the free money or the cheap money or the easy money, right? So, yeah, and we saw this last time just after the GFC. The non-bank lenders really shone in the world of, call it aggressive. I wouldn't call it aggressive, but, a bit more complex lending when you're on your third or your fourth or your fifth investment loan. The major banks aren't necessarily the best place to be. A good non-bank lender can be extremely useful at that end of town. So, It is. Absolutely. We're seeing it on the street, Andy. 90% lending, no LMI. They're self-insure, like, sharp rates. They're coming up with little products that the main banks can't match. But your everyday home loan, Andy just wants a loan and he wants to pay his home off. They really, you almost can never beat the bank on that one. But for the second loan or the third loan, well, they're really coming into their own. So, interesting times. I'm actually keen on it because, it actually busts open a little bit more market competition when those rates get a bit more fair across the board,
And the opposite, again, we've spoken about this ad nauseum, and mate, the borders are open, so we should get our butts over to Japan soon,
mate. Let's go, bro. I'm in. Christmas time skiing, and it's not skiing. We're doing a business
tour.
research
study tour to good old Nomura Bank and visit Tarachi-san and a few old mates of mine over there. But I don't trust Australia to be smart enough to look, because we're actually, our politicians are not. If they are educated people, which they have an education, at least some of them I wouldn't trust to sit the right way on a toilet seat, but I don't trust them to be looking at the greater world in order to understand what's happening. And the politicians do have influence. I trust that the Reserve Bank, would have enough to go, okay, look around the world, who's risen rates from zero. Japan tried to raise rates aggressively over there. It failed, and it blew shit up, and they had blown up, and it nearly killed them. So I'm hoping that they take heed and warning and some good research from it, because the economic philosophy that worked or didn't work on the way down, depending on what your view is, right? Because interest rates started here, and for 30 years they went like that. Now that says to me, unless your intention was to get to zero, whatever you're doing ain't working. Right? It's
exactly. You're not really watching the road. So,
once we're down here, we're hoping that they're looking more globally, and that's what, again, with investors, with people who have businesses and funds that are with the banks and we rely on this in the economy. I think we should be taking a look at at Japan and probably not being too scared by what's going to come in the press. I think we should all have our eyes open, both eyes wide open, and going, where is this going? But looking for good source of information.
Yeah, absolutely. I completely agree, mate. At the end of the day, one of the challenges, I think, and you and I talked about it, is, everyone's going to be on the crack cocaine called, cheap money. And, there's an absolute gold rush when it comes to refinancing, resetting mortgages, you name it right now, and you have a look at this trend here, from, a high in sort of 2007, 2008 of like 9%, folks, 9%. And we're down to what, like, call it 3% to be really loose. But, what did Bob just say here? He said, oh, listen, I'd have fixed, a fixed interest rate of 1.94. Like, that's like ludicrous, Andy. It's free money. And it shifted to 2.09, Bob. But he said it, he wrote, it's they bet me over, but it's still cheap, But think of that, like,
but Jeff, in the headlines, that's actually what was it? It's an 80% increase. It's the highest increase we've ever seen.
Outrageous, So it's that is, and Bob said that's like NAB, and absolutely, Bob. The main banks are in there. Someone asked about the non-bank lenders without LMI. It's not without LMI, folks. It's they self-insure, so they charge you their own fee, which is like LMI. Sometimes the challenge with lenders' mortgage insurance, Andy and everyone listening in, is they now have another opinion about what you're buying, all right? not only does the valuer fucking have an opinion, then you got the bank has an opinion, and now you got the LMI, the insurers have an opinion. You got 3 arbitrary bunches of like, pains in the ass people. Then they go, I don't like the property, right? So, it's nice to sort of eliminate one, folks. All right. So,
well, you know what they say about opinions, don't you?
Oh, well, yeah, exactly. Well, it's after 5 o'clock, Andy. It's not PG anymore,
Well,
opinions are like assholes. Everyone's
got one. Yeah.
And most of them stink, right? I told that joke once. I don't know. Andy, do you remember a guy called Neil Jedman? Anyone remember a guy called Neil Jedman, folks? Anyway, he was quite infamous in my world because he took on the sperucators of real estate, the gold chain, white shoe shuffling, 2-tier marketers in the 80s and 90s, the Dudley Quinlivens of the world. And he actually took on a bloke called Henry Kay, which you might remember, Andy, back in the Melbourne days. Anyway, he was kind of the people's, he was the people's protector, which was an absolute lie and bunch of bullshit. But anyway, I told that joke once, and he didn't think it was funny, so he gave me a good shellacking on chat rooms. But there we go. Prices. I remember Neil. Yeah, Neil. Anyway, it was a funny chap, old Neil. But and Henry Kay. They were strange days. Andy, I don't know if you remember Henry Kay's claim to fame. What he was doing is he was teaching people to get deposit bonds from the lenders. There was institutions where you could get deposit bonds. And he was teaching people to get 10, 12, 15 deposit bonds on the same day and go buy 10, 12, 15 off the plan properties off the plan and then on sell them.
Sounds like a low risk strategy.
Yeah. It was madness. It was crazy. It was about the time when I started to pay attention to that space, and I'm like, what? How does this work? I'm unconditional on 10 contracts, and anyway, yeah. Before jail, exactly, Bryce. That's where he ended up in jail. It's like, what? Yeah. So there's some crazy people out there, folks. Anyway, I don't know. What was I talking about, Andy? I think I got completely.
We were on interest rates. I think.
Yes.
From
9%.
Second tier.
3%. And Liberty, Latrobe, folks. Liberty, Latrobe, First Mac, Resi Mac. Some of these lenders, and they're very large, reputable lenders. They self-insure. Macquarie. Sometimes they can do some really interesting products, etc. So.
And most of them, interestingly enough, Jace, they actually have an investment arm where they deploy the funds commercially out the other side.
Yeah.
And it's Latrobe, and this isn't an endorsement to go out and buy Latrobe, by the way, but I think that people should have a look at it, just to see both sides, the lending side and the investment side. And Latrobe have given some outstanding returns on the cash investment over periods of time. Their due diligence has been very good. Their track record has been exceptional. And they've given investors significantly over, term deposits and actual real rates of return for quite some time. And the reason why I say that is not for you to go out and buy Latrobe investments, because that's not what I'm recommending here. This is not a recommendation by any stretch of the imagination. It's an example of what can happen when a company gets together and goes, okay, we're going to lend on one side and we're going to have investors pay for it on the other side, which is very different.
I think it's great
model.
Yeah.
Bank model is we take money from the government at a very low yield and we lend that out to the market, and then we do the rest after that. But these are companies that literally they go, Jace, you've got 1,000 people who all want to invest $1 million each. If I can give you a 4% investment return for that, and we're spread it across a whole lot of different properties, and they put together a matrix, and they go, we're going to fund people who the banks won't fund, but we believe should definitely have funding. And they figure out the appropriate risk return and the appropriate rate to charge on that. And I reckon we're going to see a hell of a lot more of that. And as potentially Facebook's, Google's, or whatever manage to crack regulation of banking in Australia and things like that, we'll see that market open up.
Mate, it's coming. And, mate, you know, right now, I saw Jeff. And folks, we'll jump onto these questions in a minute, Andy. I think it'd probably be worth having a crack at. But you know, Jeff chucked in there, you know, crypto coin up 1,000%, you know, wild rides in those spaces. But here's what I do know, Andy. There's a wallet right now that like I've got a good contact on. I'm trying to get him on for Wealth Wine and Wisdom, actually, where if you've got your coin, your crypto coin, you can have it in the wallet. You can allow access to a certain amount of people, and that crypto coin can, in the background, earn you an income, like an income that obviously people are like, trading it, short-term trading, you know, options, whatever it is, derivatives, you name it. That's been around forever and a day in the share market, right? So, you know, what the assets that you own, and you've been talking about this for a long time, right? Once we get someone's house equity, you know, on the blockchain and, you know, go, all right, well, fuck it. You know, I'll put 50 grand or 100 grand of my equity on the blockchain, and I'll give permission to the right people to short-term use that as some security to then create me an income.
Bring it on. Yeah. Like this idea of regulation and soapbox moment, like, because I'm a Victorian, and at the moment, for those of you out, don't want to get political, but Mr. Andrews is trying to pass legislation where he can call a state of emergency without consulting the health minister, without consulting anyone, and do snap lockdowns without even having to give a justificational reason for it. Fuck me. But where was I going with that? Nanny state, state, a dictatorship type of a way of telling us what we can and cannot do with our lives. And I'm talking about our freedoms and our liberties at the moment. And as in Victoria, we're pretty pissed off with what's going on. At least I hope you are, Victorians, because you should be. Again, ambivalence is the number one reason that you won't be where you need to be in the next 10 or 20 years if you're ambivalent to the politics. Jason and I, we spoke about this.
We speak about it all the time, Andy, right? Like, comfort's the worst place to be. You know, you're not paying attention and you're not listening to what's going on. Yep, absolutely. Yep.
But mark our words, within, I reckon, 10 years, you will be able to do that. You will be able to go, okay, I'll take 5% of my house and I'm going to deploy that equity over there. I'm going to take another 3% of my house and I'm going to deploy that over there, and you'll be able to do that. And at the moment, just to be able to do that, to utilize your own equity, you have to jump through hoops and regulations, which is obscene, because at the end of the day, it's my energy that I went out and deployed into the universe.
Yeah.
And it's the risk that I chose to take to invest over there and to buy this bit of real estate. And in my view, Jace, and I come from this area, I should be able to do with that whatever the bloody hell I should like to be able to do. And I went down to the bank the other day, tried to get more than $10,000 out in cash because I want to go trading. I want to buy a whole lot of garage sales stuff. I want to go nuts on this because I reckon I'll make a fortune just by picking up little things that people.
You're doing the Gary V, mate. You on the weekends, the Saturday, buddy. Yeah,
mate. I'm out and about. I'm going to be into it, like Flynn. Because Mark, mate, we'll do segments on it because there'll be some great stuff out there. But I couldn't even take 20 grand out of the bank.
Ludicrous, right?
I had to write to the bank and say, please, Mr. Bank Manager, a variation of that. But anyway, that blockchain technology, when that starts to kick off out here, we will be able to do that.
And it's coming, Andy, right? It's coming because guess what, folks? Andy, pop quiz. Who's already doing that on your fucking equity? Who's doing it? The banks. Like, folks, wake up and smell the fucking roses. You know, the banks are already doing it. You're making extra payments on your mortgages and thinking you're doing great. No, you're not. You're just giving the bank your cash, and then they take it, and then they'll do what they like. You know, they've got these ability to then on lend certain things. Your mortgage is their asset, folks, you know. And it's an interesting idea. Oh, there you go. You're in the iPad, Andy. Right.
I have, mate.
I'll turn you on. There we go. Boom. Let's put him back. All right, turn that one off. The iPhone's gone. Andy's iPad is back. Andy, the iPad. So, but you know what? Like it's in real, like it's already happening. Andy has been for decades. It's just we as the person, we as the owner of that real estate haven't benefited directly, and we should. It's our bloody piece of real estate. Like you said, it's your thing. You spend 30 years paying that thing off, and then the bank has had it as an asset for them for 30 years, where they can trade it on the short-term cash market or do whatever with it because it's their asset. That's why they lend you 80%. Well, that's bullshit. So it's an interesting one, Andy. The next decade, exciting times, I reckon, in that space. And I reckon you got to get a piece of it personally. Yep. There you go. Oh, well, let's quickly, I think we should just jump onto this question maybe here, Andy, and kind of on the back stretch, actually. An hour's gone by in a flash, mate, and your phone lasted all right, actually. So that wasn't too bad. I thought it'd be over in 10 or 15 minutes. But anyway, so I don't know who this was, but sort of, this is talking about retirees, as they retire into, create liquidity, pass on portfolios, you're going to feel downward pressure on shares and equity markets, as it's not a high desire factor for the younger generation, potentially, maybe. Thinking cash will move from shares into other assets that are in more vogue. Curious on those thoughts for long term, Andy. It sort of brings up for me one of your favorite sayings. What is it? History. It's a good mimic. It doesn't repeat itself, but it certainly mimics certain things.
Mimic.
Yeah. And it's Todd dialing in for us there. So thanks for the question, Todd.
Mate, can you just read that out or paraphrase it for me?
Yeah, I'll read it out. So okay. So as kind of the baby boomer, the portfolios and the assets of the baby boomers, from 10, 15, 20, 30 years ago, kind of, liquefy and turn into something and pass on. Are those assets going to be in vogue? Maybe a question is like, someone used to have bank shares and now we don't want bank shares. We want Dogecoin, right? Who's going to buy the shares that they sell? Is that something we need to keep in mind? Like the change of asset classes, that ever happened in history that we know of? I don't know if a house will ever go out of vogue, but it's interesting. It's a good question. It's quite a deep question, isn't it?
Look, from a futurist perspective, you would start thinking in and around ultimately what is it that people value. Commercially, if a business continues to develop and continues to earn coin and profit and distribute profit, then that's always going to be an investment. Now, whether that is an investment via a way of a share in its current form, or whether it's an investment via a way of an NFT, a non-fungible token, that may represent a bank interest. And I'm talking from the opinion area right now, and I'm pulling it right out. So it stinks a little bit, but let's just say that banks want to launch MLC as an example, a second tier funding model, and they want equity to do that. They might issue non-fungible tokens instead of shares in the future, and that non-fungible token might come with a series of contracted benefits that you get that go further than just shares. Right? At the moment, shares basically just give you a percentage of ownership and a right of distribution based on the percentage of ownership that you have. In the future, that may change to features and benefits that are more valuable to you. And so the mechanism mightn't be via a stock market. It might be via the blockchain, via an NFT or something to that effect. So I think you will see the type of asset class change quite dramatically. Now, the biggest thing that is going to slow that down en masse are going to be regulation and governments that and you're going to see a huge amount of the wild west. And this is both an opportunity and it's also progress with caution, because where you see the future is going, you've got a great potential to go out there and make money and really be ahead of the curve. But you're also going to play with a lot of people who have also got the same idea and maybe better funding or more manipulative.
They're well funded. Yeah.
And when you're in a less regulated space, it's take no prisoners. You will get hurt if you cannot afford to take the risk and you take it. Then you will become collateral damage. So I think it's going to be really interesting, Jace. I think that, yeah, so to answer the question, fundamentally, yes. I think that the asset allocation model, of which most investing is done by and regulated to be done by, I think that's broken.
Yeah.
There is already a major shift in what a good investment portfolio should look like, but we're not allowed to make it look like that because ASIC and the regulators don't understand them.
I mean, the regulators are what? I mean, 30, 40 years behind the actual market, Andy. I mean, the laws far out. How old are they, in this space? You know what I mean? So,
well, modern portfolio theorem and the diversification model of ASIC is built on Harry Markowitz's Nobel Prize.
Like 1908 or something.
Like something ridiculous like that. Yeah. We're well past it. Like
ludicrous. Yeah, ludicrous. And, let's hope that, where Australia was cutting edge 30 years ago, Australia actually came up with the silicon chip, Andy. Like we were the country that created the technology that the silicon chip was created upon. And from that sort of crowning glory, it was only a decline from there, sadly, with our governments.
Didn't we manage to fuck that up? Because now there's a shortage of silicon chips, and if we were sitting there still running the race,
but
tech.
Yeah, it's so there's a transformation occurring, and like in my world, I'm like, we got to be sensible. At the end of the day, we can't. It is not prudent for anyone's safety or capacity to just rip apart the existing infrastructure, like just destroy it in 5 minutes. That is dumb. That's stupid. That's anarchy. However, we must fast and furiously integrate these decentralized technologies and use them for our our country's benefit, for the world's benefit. But we must embrace them because they're here. What is it? Was it $3 trillion or something? Bitcoin's market cap, Andy?
It was the crypto space. But it was really run by three of them: Ethereum, Bitcoin, and I've forgotten the other one off the top of my head. But yes, yeah, it was the largest single asset class other than property.
Yeah. So it's it's here to stay. It's not going away. And fantastically, I think fantastically, you and I have talked about there's such friction and inefficiency between the end user and a thing, an asset, something. There's these middle people, these middle in the middle. The middle should be scared. The end user now has what it should have, the reward for its risk. The lazy fat middle should be the ones that like, fuck, I need to change my business model, right? And that's the way it should be. Personally, I think that's great. That broker in the middle is unrequired if this technology is managed properly. Sadly, well, not sadly, I think naively you could think that governments can't be involved, but just remove the word government, because if that triggers you, well, that's just the way it is. There has to be some management of it where there is kind of some mechanisms of oversight and some sort of governance, so we don't have the world where, you know, Andy thinks, oh, I'm going to invest in NFTs and he loses everything he's ever fucking had in his life in 5 seconds flat because it was run by, I don't know, fucking maybe this is not the right commentary, but, you know, Nigerian scammers, let's say, right? Like, so there has to be some mechanism, Andy, of management, you know, but it's got to be managed some way. So I don't know the answer to that, but I certainly do know that this technology is absolutely gonna bust it open for the good. I think, you know, at the end of the day, we've noticed the fat middle, you know, the fat, lazy, you know, annoying middle has always pissed you and me off endlessly.
And I think that the new asset classes that will evolve will be asset classes that have been available to the wholesale and institutional investor for many years.
Dead right. Yeah. Yeah. And then they're making 10, 12, 15% margin, and us at the fucking bottom end, you go like, can we get 0.5%? You know, like, yeah, nah, mate. You know, what are you going to get in the bank? Well, 0.5% on my money. Well, how come those people are making 8% and I get 0.5%? What? Where's?
Because we need to protect you.
Yeah. Yeah, exactly. Mate, I think that's a very interesting conversation, and one I think would be great to put a pin in. I agree with you, mate. I'd love to see us put together a little bit more detail on those interest rates and bond rates and a few other bits and pieces. I think that'd be great. So we might call it done and dusted. We thought we would not get through today on Wealth, Wine and Wisdom because of Andy's power shortage, but he's managed extremely well at your end, I think, mate. Well done. And you know, good job, folks, for sticking in there and hanging out. But other than any other questions that might come on through, I think we're done and dusted, Andy. Well, I did have a little Pinot, by the way.
Oh, look at you.
Pinot. Yeah, it was a nice drop.
The old sawmill.
Yeah, not too bad. I highly recommend, mate. I highly recommend.
How many days has that been open?
Oh, only 2 days. Only 2 days. I had a glass yesterday, and I had you on my fucking shoulder, Andy. But no fucking. Yeah. That's funny. Well, mate. Well, folks, great to hang out with you guys. Awesome to you know, chew the fat. Another Wealth, Wine and Wisdom done and dusted for Friday, the 29th of October. Awesome to hang out.
Yep. State and the Sunshine State.
Yeah, absolutely. Well, I think that's it, Andy. Well, it's a good night from you.
And it's a good night from him.
Good night.
Good night.
Happy